Welcome to This Explainer. Today we're diving into a genuinely fascinating shift in the fast food landscape. We're going to see how a legendary burger giant is quietly stepping into a brand new $100 billion global market. And the crazy part? This move is specifically designed to skyrocket their sales and basically offset the crushing weight of global inflation. McDonald's is making a massive pivot right now, and guess what? It's not about the burgers or the fries. It's literally all about what's in your cup.
So let's really get into this by looking at the massive macroeconomic pressures hitting fast food today. Right now, the entire industry is facing a massive margin threat from incredibly expensive commodities, specifically beef. Think about it. When your absolute primary product is getting more and more expensive to produce, how on earth do you maintain profitability without just passing every single cent of that cost onto a really price-sensitive consumer? Well, you have to hunt for a margin multiplier.
Here's our roadmap for today. First, we'll explore that $100 billion beverage opportunity. Then, we'll unpack the key learnings from their experimental laboratory. Third, we'll see exactly how this drives higher checks and incremental traffic. And finally, we're going to methodically connect these fun new drinks straight to hard corporate financial metrics, like EPS, dividends, and expected future growth.
All right, let's kick things off with Section 1, the $100 billion beverage opportunity. McDonald's is aggressively targeting the global specialty drink market, and it's fundamentally re-engineering their value proposition. The core economic logic here is pretty brilliant. On one hand, you've got traditional food and beef. These are high-cost, relatively low-margin, and pretty much locked to primary mealtimes like lunch and dinner. But on the flip side, you have specialty beverages. We're talking about ice, carbonation, and syrups. That translates to an incredibly lucrative, high-margin reality. Plus, they perfectly target that mid-afternoon snack time, a time of day every chain is desperate to grow.
Just listen to how Alyssa Buyetikofer, the Chief Marketing and Customer Experience Officer for McDonald's USA, puts it. She says, "And soon, our beverages won't just be a reason you come to McDonald's, they'll be the reason." Wow. I mean, that is a powerful statement. It totally illustrates this deliberate Trojan horse-style strategic shift. They're moving toward becoming a beverage-first destination to capture those high-margin, traffic-driving visits that have historically always gone to specialty coffee shops and drive-thrus.
Moving right along to Section 2, learnings from the laboratory.
Look, you don't just roll out a massive shift like this across nearly 14,000 U.S. restaurants without making absolutely sure your operational efficiency survives, right? So let's trace how they pulled this off. In late 2023, McDonald's launched that wild cosmic spin-off concept specifically for testing. While that standalone concept wasn't meant to scale everywhere, it was basically a massive data gathering lab. By Q4 2025, they took those learnings and ran a super successful 500-store test under the McCafe brand right here in the US. And now, in May 2026, boom, we get the nationwide rollout of these new drinks.
But here's the catch, and it was a big one. Operational complexity was the absolute main risk. The Cosmix tests revealed a glaring issue. Making these highly customized drinks could slow drive-through times down to nearly 18 minutes. 18 minutes? In a fast food drive-thru, that is practically a lifetime. If you frustrate your customers and your workers with slow service, you lose. McDonald's absolutely had to find a way to maintain their legendary speed while still offering complex, personalized beverages.
Enter the brilliant solution to the speed problem. McDonald's introduced the beverage specialist. This is an entirely new in-restaurant role. These specialists work at a decoupled, dedicated station behind the counter, fully equipped with everything they need for mixing syrups and storing cold foam. By totally separating the drink infrastructure from the main food kitchen, they protect the fast food pipeline, prevent massive bottlenecks, and ensure both consistency and speed.
Let's dive into Section 3, higher checks and incremental traffic.
So, how do these specific new menu items actually change what consumers are buying? Well, just check out this lineup. We're talking about the Dirty Dr. Pepper loaded with vanilla and cold foam, the Orange Dream featuring High C Lava Burst, a Red Bull Dragonberry Energizer, Sprite Berry Blast, and these brightly colored caffeinated fruit refreshers with popping boba. McDonald's is energetically leaning right into the Gen Z-approved dirty soda trend imported from Utah. They're sweet, they're fun, they're highly personalized, and yeah, they look incredible on social media.
Economically speaking, these drinks are acting as the perfect buffer. We know diners have been downsizing their regular meal portions lately because of inflation, right? But a $3 to $5 specialty beverage? That acts as an affordable, incredibly high-margin add-on. It sits perfectly right between a splurge and a necessity. It lifts the average check size without making the kitchen sweat, and it gives people a very real reason to swing by mid-morning or late afternoon, driving that essential incremental traffic.
And when you compare the wider landscape, the strategy becomes crystal clear. Look at the average customer spend in 2024. You've got $9.34 at Starbucks and $8.44 at Dutch Bros. McDonald's is aiming to totally disrupt this premium pricing by using their value-first doctrine. They are offering fancy, customized drinks at a much lower price point, leveraging their massive scale to make premium beverages way more accessible to the budget-minded consumer.
Finally, let's hit Section 4, EPS, dividends, and future growth.
We can translate this entire beverage strategy directly into shareholder impact. Look at the financial foundation here. McDonald's reported a record Q4 2025 revenue of $7.01 billion. That is a 10% increase. They also saw global comparable sales rise by 5.7%. This really proves that the company's financial footing is robust. They're generating massive free cash flow, which provides the absolute perfect runway to support the super ambitious pivot into the beverage space.
When we break down the Zacks consensus estimates, we're seeing a projected earnings per share uptick of 8.4% in 2026 and 9.2% in 2027. A huge piece of that growth is expected to be driven by these new higher margin sales. To keep the engine fueled, McDonald's plans to spend between $3.7 billion and $3.9 billion on capital expenditures in 2026, primarily to accelerate new unit development. And for the investors out there seeking stability, McDonald's currently boasts a dividend yield of around 2.56%, having actually increased their dividend for 49 consecutive years. That is wild, and it totally reinforces the company's status as a defensive blue-chip stock. So even while they're aggressively pursuing new growth through beverages, they're maintaining a very consistent and reliable return of capital to their shareholders.
Now, market sentiment on this pivot is definitely mixed. The consensus is largely a hold right now, because the stock trades at a premium forward PE multiple of around 24.44x, which means a lot of this growth is already priced in. However, others see it as a buy on significant dips, and then you have the highly bullish analysts, like those at Tigris Financial, who are targeting $385 a share, banking hard on the multi-year growth engine of this beverage supercycle.
All of this data feeds directly into their massive Accelerating the Arches expansion plan. And the steps are aggressive. They want to launch 2,600 new restaurants in 2026 alone, scale their digital loyalty program to a staggering 250 million active users, and ultimately hit 50,000 global locations by 2027. They're maximizing their physical real estate footprint and their digital ecosystems specifically to pump these new high-margin drinks out to the world.
I think McDonald's CEO Chris Kempczinski perfectly summarizes the thesis driving this historic shift. He stated, "The beverage category is growing faster than the rest of casual dining and with superior margins." That right there is the margin multiplier in a nutshell. It's a calculated, massive bet on volume and profitability designed to insulate the company from economic headwinds.
So, we are left with a massive question for the future of fast food. Will a $3 Dirty Dr. Pepper actually be the ultimate margin protector against global inflation? Will this under-the-radar strategy ultimately crown them the new king of specialty beverages, toppling the old giants? It's an absolutely fascinating pivot, and we'll definitely be watching the data closely. Thank you so much for joining me on this explainer, and keep learning.